Today, the Alice in Wonderland world, the DFA Daily for the 1st of April 2020. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. There was another drop of news today, which frankly taken together shows no one really knows what's going on. For example, according to Domain, the current situation evidently offers a once-in-a-generation buying opportunity, saying, in the midst of the pandemonium, Australia's apartment market could stay afloat from young buyers with a deposit and job stability as plummeting interest rates and cheap stock spark once-in-a-lifetime buying conditions. Post-election, it was like a light switch for the apartment market. The amount of people attending open homes was incredible, and the prices being achieved were incredible too. But now is one of the best times you could possibly buy a property if you have that security. Well, maybe. If we weren't in for a massive drop in income, a potential fall in capital values to unplumbed depths, and unknown economic chaos ahead, would I buy now? Not a chance. And another reason to hold off is the unavailability of lenders' mortgage insurance, normally required for loans above 80% loan-to-value ratio. Obviously, with prices likely to fall, they would be catching a falling knife. So QBA announced the withdrawal of their 2020 guidance on Monday, and they also throttled back their lenders' mortgage insurance as they notified lenders that it had suspended mortgage insurance coverage for new loans taken out by home buyers employed in industries hard hit by the current crisis. While the move reflects prudent risk management by the insurer amid rapidly deteriorating business conditions, it could rankle political leaders who last week called on the insurance industry to continue underwriting risks in the Australian economy. And this was laid bare by Banking Day as a QBE spokesperson defended the company's decision, arguing that lenders will be inclined to curtail home lending in response to the current events. We expect responsible lending obligations would have put a stop on much of the lending, the spokesperson said. The temporary embargo was issued to all of our lenders, although they have the ability to seek exceptions. And Genworth, the other LMI, said that their company had not changed their underwriting standards at this time. We support our lenders who must apply responsible lending standards and assess applications on their merits. We note that the standards require lenders to consider borrowers' current circumstances at the time of lending. And Auswide also revealed that it was introducing an across-the-board suspension of lending to people employed on casual contracts. Effective immediately, the acceptance of casual employment as an income source has been suspended, the bank told brokers. It is important to note that this is not a permanent change. However, at this stage, it is considered a prudent and responsible lending measure for customers with this income type. So in effect, mortgage lending is stalling. And so are home prices, because even the bullish core logic is changing its tune, at least a bit. Tim Laws said the housing market won't be immune to a drop in sentiment and weaker economic conditions. However, the extent of the impact on dwelling values remains highly uncertain. Capital growth trends will be contingent on how long it takes to contain the current issues and whether additional constraints on business or personal activity are introduced. From a transactional perspective, Lawless said, we are expecting the number of residential property sales to fall dramatically over the coming months, a consequence of tanking consumer confidence, a rising jobless rate, and more cautious lending practices. Restrictions on open homes and on-site auctions will compound the slowdown in buyer activity, as would any future policy announcements related to peripheral services such as building and pest inspections, conveyancing, and furniture removals. Considering the temporary nature of this crisis, along with unprecedented levels of government stimulus, leniency from lenders for distressed borrowers, and record low interest rates, housing values are likely to be more insulated than sales activity, Lawless said. The extent of any fall in housing values is impossible to fathom without first understanding the length of time this health and economic crisis persists. Arguably, the longer it takes to contain the risks and bring economic operations back to normal, the higher the downside risk to housing values. And you can get my latest take on what's happening by listening to my live podcast tomorrow at 12:30 on the Nucleus Wealth podcast series. I'll put a link below. My survey data is telling a pretty unhappy story, and here is a clue. Perth's house prices are down by around 21% from peak over 5.5 years, with an unemployment rate that peaked at just 6.9%. Now, I'm expecting a rate closer to 10%, even after all the government intervention. Only one way down, I fear. And talking of unhappy stories, at least for bankers, in the UK, banks, as reported in The Guardian, said that Britain's largest banks have agreed to scrap nearly £8 billion worth of dividends in the light of the current crisis, giving banks an additional cushion to weather an economic downturn. The Bank of England has also ordered lenders to cancel plans for cash bonuses for executives as it asks financial institutions to boost their strength ahead of a likely recession. In a series of coordinated statements, the UK's largest lenders, including Barclays, HSBC, Lloyds, Royal Bank of Scotland and Standard Chartered, confirmed on Tuesday that they would temporarily halt shareholder payouts and share buybacks for 2019 and throughout 2020, following discussions with the bank. The cancellation of 2019 dividends will give the banks an additional financial cushion worth nearly £8 billion in total, as they are pushed to increase lending to businesses and households during the current lockdown. And bankers' bonuses are also on hold. The supervisor said they expect banks not to pay any cash bonuses to senior staff, including all material risk takers, and it's confident that bank boards are already considering and will take any appropriate further actions with regard to the accrual, payment and vesting of variable remuneration over coming months. And the AFR reported that in Europe, governments and the European Central Bank have moved to ban dividend payments by companies, and this raises the question, of course, how can shareholder returns and state support coexist? France's Finance Minister Bruno Le Maire has demanded a ban on dividend payment by companies receiving state support. The minister threatened any company with penalties, including additional tax liabilities, if it pays dividends until the current threat is beaten. In Germany, the government has advised that all companies receiving financial assistance should stop dividend payments to prevent capital being distributed to shareholders that could be allocated for the current fight. But of course, in Australia, nothing here yet. But then, given the massive government support the banks are getting, surely it's only a matter of time. Or is it? Westpac has revised down their unemployment forecast from 17% just about a week ago to now 9%, taking account of the latest government stimulus. They now expect GDP will contract by 8.5% in the June quarter, to be followed by a 0.6% contraction in the September quarter and a 5.2% lift in the December quarter. Of course, they are therefore assuming that the medical emergency will be solved quite quickly. And they say overall the economy is expected to contract by 5% through 2020. And they're forecasting a bigger deficit and said that if the increased deficit is fully funded by bond issuance, the bond supply is expected to lift by an additional $310 billion compared to their previous estimate of $250 billion. And Westpac also commented on the stronger than expected dwelling approvals for February from the ABS, saying dwelling approvals came in much stronger than expected. The headline number was up 20% in the month on a 60% spike in unit approvals. The consensus had been looking for a 4.5% rise. The picture, however, was softer outside the high-rise, with detached house approvals down 0.8% and total approvals, excluding high-rise, down 1.2% in the month. High-rise unit approvals essentially doubled in the month. And by state, the jump was concentrated in Victoria, which saw total approvals spike 55% higher in the month, despite a 6.1% drop in detached house approvals in the state. And across the other states, New South Wales, South Australia and Tasmania posted solid rises, but Queensland approvals were down. Now, of course, we should ignore this headline, because the high-rise sector is always extremely lumpy. You just need one large approval for one large high-rise, and that puts a big dent in the numbers either way. Many other projects will be shelved or delayed as the social restriction measures impact activity, and the substantive hit to the economy sees a pullback in new building. So really, again, more meaningless figures. Although the HIA was talking them up, at least up till the end of February, they said we are looking at solid home building activity across most regions for 2020. Note the past tense. And the superannuation sector is under pressure, and Senator Jane Hume has warned super funds to stop dragging their feet and allow members to withdraw their funds. The second tranche of the government's measures to tide workers through the current crisis allows individuals experiencing financial hardship to withdraw up to $10,000 from their super fund. But Senator Hume has put super funds who might be dragging their feet on the change on notice, saying no part of society or the economy is a sacred cow. When we emerge out on the other side of this crisis, the Australian people will remember who stepped up and who checked out. There is no doubt we will recover, but I think we all know that this country will never be the same again, and every industry in Australia will change after this. Ms. Hume accused some super funds of self-interest dressed in sanctimony and said that some were claiming immunity from the changes on the basis of a higher calling. If a fund has run a fair weather only investment strategy, they will be exposed, she said. And the Australian industry group, Australian Performance of Manufacturing Index, jumped by 9.4 points to 53.7 in March, indicating an expansion in Australian manufacturing after 4 months of contraction, seasonally adjusted at least. Results above 50 points indicate expansion, with higher results indicating a faster rate of expansion. Now, this somewhat surprising expansion in the midst of the current crisis is almost entirely due to a huge surge in demand for, guess what, manufactured food, groceries and personal care items, as shoppers stock up on processed food, toilet paper, cleaning products and other household essentials. The local manufacturing sectors that make these goods, mainly food and beverages and chemicals, account for a large proportion of Australia's manufacturing in 2020 compared to past decades and compared to other countries, and so these sectors make a relatively large contribution to the headline index. In contrast, the more traditional heavy industry manufacturers reported contracting conditions in March as local and export demand for machinery, equipment, building materials and especially metal products evaporates. The timing of responses was also significant. Responses received earlier in the month, before the announcement of widespread activity restrictions in Australia, were more positive than those received towards the end of March. And responses from the food and beverages and chemical sectors remained positive up to the end of the month. But in contrast, the metal producers sector, which produced $17.8 billion in real value-added input to the fourth quarter 2019, which was 17% of manufacturing real value input, it employs 146,000 people and 16% of manufacturing. The metal products index fell by a further 2 points to 34.5 points in March, indicating a faster rate of contraction and the lowest result since July 2013 in trend terms. And many respondents said that current restrictions meant they were shutting down their operations. And some respondents noted that the demand had already been low for some time before the latest health crisis. But I left the really big item till last today, because the Federal Reserve on Tuesday announced the establishment of a temporary repurchase agreement facility for foreign and international monetary authorities to help support the smooth functioning of financial markets, including the US Treasury market, and thus to maintain the supply of credit to US households and businesses. This repo facility will allow account holders, which consist of central banks and other international monetary authorities with accounts at the Federal Reserve of New York, to enter into repurchase agreements with the Federal Reserve. In these transactions, these account holders temporarily exchange their US Treasury securities held with the Federal Reserve for US dollars, which can then be made available to institutions in their jurisdictions. This facility should help support the smooth functioning of the US Treasury market by providing an alternative temporary source of US dollars other than sales of securities in the open market. It should also serve along with the US liquidity swap lines that the Federal Reserve has established with other central banks to help ease strains on global US dollar funding markets. The Federal Reserve provides US dollar denominated banking services to these account holders in support of Federal Reserve objectives and in recognition of the US dollar's prominent role as an international currency. This repo facility, which adds to the range of services the Federal Reserve provides, will be available from April the 6th and will continue for at least 6 months. So another step in the Fed's play for world domination of the financial systems and its drive to keep the US dollar relevant. Despite all of this, the local markets actually had a good day today. So the ASX 200 was up 3.58% today to 5,258. The financials index was up 2.57% to 4,372. And the real estate trusts were up 5.23% to 1,075. The volatility index was up 14.42% to 4076. And the ASX 200 futures was up just 0.13% to 5,201. Amongst the banks, ANZ was up 2.4% to 1705. CBA was up 2.19% to 63.67. And NAB was up 2.02% to 16.95. Westpac was up 2.33% to 16.70. And the Bank of Queensland was up 1.6% to 5.08. Bendigo and Adelaide Bank was up 2.87% to 6.45. Suncorp was up 3.29% to 9.43. And the Macquarie was up again 3.57% to 88.72. AMP was up 4.12% to 141. And the Lenders Mortgage Insurer Genworth was down 3.69%, not expected given today's announcements from QBE. It's at 2.09. McGrath was down 5% to 19 cents. And Yellowbit Road was at 5.6 cents. AFG was down 1.1% to 135. Mortgage Choice was down 3.68% to 0.65. And CIMEC was up 1.52% to 23.60. The US Aussie dollar was down 1.19% to 60.64. And the Euro Aussie dollar was up 0.32% to 1.8026. The 2-year bond was up 2.35% to 0.218, and the 10-year bond was down 1.02% to 0.678. The Aussie Gold Cross was up 0.15% to 2,629, while the Bitcoin Aussie Cross was down 1.4% to 10,427. Recapping on New York last night, the Dow Jones was down 1.84% to 21,917. And the 500 index was down 1.6% to 2,584. And the financials index was down 1.04% to 346. The Nasdaq was down 0.95% to 7,700, while the Nasdaq futures was down 2.36% to 7,602, and the S&P 500 futures was down 2.74% to 2,499. So more ups, more downs, all signs of that bear market. But coming back to my theme of Alice, this is all going down the rabbit hole, isn't it? So many different things going on, so many cross currents, and so many unknown unknowns. I'm afraid that this is going to continue for quite some time, so we'll go on telling the story each day to keep you informed. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.